Good afternoon, everybody, and happy Valentine's Day to you. The question that we're asking today is the market gearing up for a major bull run, or is this just going to be another fake out? Smart traders know that not all breakouts are created equal, and jumping in too soon can be very, very costly. So, in this episode of the Traders Mindchat show, we're going to break down key confirmation signals, how to tell if this rally has real strength or if it doesn't, time saving analysis for part time traders, how to assess market strength quickly, and as a bonus, if we have time, hopefully we will, how to manage risk while positioning for big potential upside. So let's hop on over to the charts and we will get started. So here is the major indexes. We have the S&P 500, the Nasdaq, the Russell 2000, the New York Stock Exchange, the Dow, and here is the IBD 50. Now, I like to take a look at all these indexes all at the same time because it helps give me a real-time feel of are they moving together or are they not? And the thing that I've observed over time is that when they're all moving together, that's when we tend to get the nice, smooth moves in either direction, whether it's moving to the upside or to the downside. But when you have one that's kind of going this way, another one that's kind of going that way, that's when things start to get a little bit hairy. And that's what we're seeing here. When we have the Russell 2000 that's trading below its 50-day moving average, and it attempted to get back above it today. And guess what? So far, still time left in the day, but so far it hit its head. It's at the low of the day. But you also have the 50-day moving average on the Russell 2000 that's curved downward. When moving averages are curved downward in this way, it adds another layer of resistance. And that layer of resistance, when we're talking about the general market, it can create a drag on the other indexes too. So that's one of the reasons why I want to take a broader look at all five. And laying it out in this way, it's pretty easy to do. I actually did another video on my layout in TradingView. The platform that we're using here is TradingView. So if you haven't seen that video, go check out that video and it'll walk you through step by step how to make this. And you'll be able to just pop it open, take a look at, and filter out so much of the noise out there. So, well, we have the major indexes here. Something else, the IBD 50. That this is what a lot of the growth stocks, a lot of the big growth stocks are in and are doing, and it's a great reflection of it. So, what kind of stocks am I talking about? I'm talking about Hood, Apps, Palantir, and many other ones like that. Netflix, Meta, DOCS, those kind of names. That's what's pulling the IBD 50 up. And if you're like me and you're trading growth stocks, this is an ETF that you want to follow. Now, it's one thing to look at what the indexes are doing on the daily time frames. I also like to take a look and see, well, what are they doing over here on the weekly time frames, and how do they look over here on the monthly time frames? Because if we have this picture of monthly, weekly, and daily, then we've got a real good feel of what's it look like at the forest level, the tree level, and the individual leaf level. And so zooming out to the tree level here, the weekly time frames, it's looking fairly constructive on the S&P, on the Nasdaq. The Russell is iffy with the 10-week line curving down, but so far the Russell is closing at the upper end of its weekly trading range. Okay, that's good. The NYSE is an eyelash away from all-time highs. So is the Dow. And so there's plenty of positives on the weekly time frames. And then when you zoom out to the monthly charts, it's like pullback. Well, pullback. Where's the pullback? So there's a lot of noise that can happen in the daily time frames. There's a lot of chop that can happen in the daily time frames. If you're swing trading and you're going for these smaller moves and you're in and out and you're keeping tight risk, yes, you can make money quickly, but you could also get shaken out and chopped up fairly quickly too. So there's this give and take. Is it breaking out? Is it a fake out? And how should we manage both scenarios? And that's what I want us to really get into. How do you manage both scenarios? We need to be prepared for both. So the way that I like to prepare for both, and for those of you that are new, yeah, you'll enjoy this. For those of you that have been here before, this will be good review. This sheet right here. You may have seen me talk about this on IBD Live this morning, but this is how I like to look at the market. I like to look at it through three lenses: the general market, your system, and your personal performance. Now, you can feel free to put whatever you want into each one of those three lenses, but the key to coming up with a process, a great process for yourself, is that you want to clearly define what you're going to put into any of these and then stick with that, because anything that falls outside, that's the noise. So for me, like what I'm putting in here, I'm putting in the major indexes that we just discussed. I'm putting in the different time frames that we discussed. I'm also putting in distribution days. I'm also putting in new highs versus new lows. So let's talk about new highs versus new lows, because they've been a little bit wonky lately. So here's the new highs versus new lows. I'll make this spreadsheet a little bit bigger. I'm a little bit of a nerd. I like to track everything, and I have all the trends of the indexes across the different time frames here. S means sideways. The S plus means that has a positive bias. The negative means it has a negative bias. Uh, but over here, we have the number of stocks making new 52-week highs versus new 52-week lows. And just like how I mentioned at the end of IBD Live today, it, two things. Number one, I've gone and I've back tested back to the year 2000. That's as much data as I was able to get on new highs versus new lows. There's never been a sustained uptrend of more than a few weeks where you have new lows outpacing new highs. And the second thing is that, well, yeah, that kind of makes sense, doesn't it? If if the index is going to move higher, then it stands to reason that the number of stocks within that index should be moving higher, right? And if you have a lot of stocks that are making new lows more so than making new highs, well, that's going to be like trying to sprint with an anchor behind you. So that's what the 52-week highs versus 52-week lows is there and is doing for us. And over the past several weeks here, you can see that it's been pretty choppy, right? That going back to January, going back to December here, it wasn't until early December, late November that we were really rocking and rolling here as far as the new highs versus new lows go. And that's when, if we flip back over to the indexes, that you could see that the indexes started to get into some trouble here. So what do we look for? I want to see new highs start to outpace new lows, and to do so in a sustainable way. We started to see new highs outpace new lows 2 days ago. We'll see what happens moving forward, but it's one of those things that needs to turn and then stay steady. So then the next question might be, well, what do you do until that happens? Right? Because we don't want to just sit on the sidelines. Well, that's where this idea of this traffic light system comes into play. If it's red, yellow, or green, red doesn't mean that I'm out of the market. It doesn't mean that I'm not putting on any trades. What it means is that if I find high quality trades that are part of my system, then I'll go in with a much smaller size. My preference of sizing is 6.5% of capital allocation to a new trade. And the most that I would risk is just 0.5% of capital in that trade. Now, we want to flip over to uh, my website, marawolf.com, because over there I have a pretty nifty tool that I can show you guys that I think will be of value to you. So I'm just going to put in marawolf.com and it pops right up. You guys could click the QR code and go over there. There's this tool here for position size calculator. It's free to use. So you just go to marawolf.com, click on position size calculator, and you'll be able to figure out, well, how much size should I be putting on this trade? Let's say that you have $100,000 of capital, and let's say that you're in this red condition, or actually right now we're in a yellow condition. So I'll give you what I use for yellow condition. If I'm making progress, I'll go up to 1% capital risk, and I'll go up to 12.5% capital allocation. So here's how I would start to figure that out. Let's say that we'll put 1% of capital risk in here. And let's say that we wanted to trade, I don't know, let's go back over to Trading View. And let's say that you wanted to get into, let's see, I got into Docs yesterday. I got in at what did I get in at? 76 and change. We'll flip back to this chart here, and I think I've got there. Yeah, 76.60. So $76.60. And the stop that I had was 71.40. So if I'm going to risk 1% of capital, this is telling me that I could put up to 14.7% of that capital in, because, well, that's why we're using the nice round number, right? 14,730 is 14%, 14.7% of 100,000. I could buy almost 200 shares with that. For me, I'd probably just round it up to 200 and have that nice even number. And yeah, it's a little bit more. But in looking at this, what I would notice too is that we're in a yellow condition. I wouldn't want to go beyond 12.5% capital allocation. So what do? I can dial down my risk a little bit. So I'll put in 0.9 and see what that gets me. Oh, I could go down even further. Let's go to 0.8. All right, a little bit higher. All right, so I could go up to 0.85%, 0.85% capital risk, well, which is great. That means that I could still get my size on. I'll be buying a few less shares, and I'll be able to get my size and risk less. Instead of risking $1,000, I'd only be risking $850. That's what I like about having all this here. And that's why I have this tool available for free over at marawolf.com. So go check that out. But the idea with this is that we really want to be managing our risk well. And that's what looking at the market through these three lenses can help us do. So the next thing to consider, right? So we spoke quite a bit about the general market and looking at the major indexes, seeing how they're moving, the number of stocks making new highs versus new lows, but we also need to talk about the system. Well, what stocks are passing your screens? What stocks are setting up for you? Do you have a lot of stocks setting up? Do you have very few? Are they high quality? Do you have a way to tell if they're high quality or if they're not high quality? Well, what I like to do is I like to see if the stuff that I'm looking at is high quality. And the way that I do that is through this right over here. Now come over to the setups model book that I have. I have this in my playbook, and I give this whole playbook. It's available. All the setups that I trade, it's available in my book, The Trading Mind Wheel. You could go get that one. That one's available on Amazon. You can scan the QR code for that. But this whole spreadsheet, I actually give this whole spreadsheet inside our accelerator program. And so for anybody that wants to come and work with me and get some guidance on this stuff, then you're welcome to go over to marwealth.com or click the QR code to learn more about the trading accelerator. But I'll take off that QR code for a second and walk you through some of this stuff. So what we have here are the setups that I trade, but I've gone the extra steps to say, okay, where am I going to find this thing? How long do I want it to be? What's the depth that I'm looking for? How should it look? Where should it be within the trend? What market types? All these little tiny details, because it's those details that'll help me figure out, well, what's a good one versus what's a great one, and when should I just sit on my hands? That's one of the toughest questions to answer as a trader. When should you sit on your hands? Well, in my opinion, the time to sit on my hands is any time that I don't see one of these, right? So I'm looking for all the different setups in here, and there's a few different setups in here, but we'll just click on this first one here. This is a model of a pullback, ZS from 2021, right? So this is what I look for, right? So if I find a stock that looks like this, that's behaving in a very similar way, and I'm just flipping through charts and I spot this, then oh, I might want to dig into this one and see, does it really match the model? Does it really match what's on this spreadsheet? And then it gives me a real clear-cut way in order to do that. But if let's say I didn't have this and I'm just trying to remember, well, what I saw on YouTube one day, it's going to make life a lot harder. So my recommendation to you, if you don't have something like this already, spend an afternoon or two taking this, putting it together, and then finding models that you could go and have as part of your model book. It's a fantastic exercise. And then finally, the last thing that'll help you to figure out, well, how heavy should you be? How light should you be? Is this part right here. That part right there, your personal performance. If you have a system and your system is analyzing the general health of the market, it's screening for stocks, it's showing you, are there a lot of stocks? Are there a few stocks? Are there high quality setups? And you take those high quality setups because, well, why wouldn't you? They're high quality. And you trade them in the way that your system tells you to trade them, then that in itself is going to give you fantastic insight into the overall health of the market. So tracking your personal performance is key for how heavy or light you should be. So one of the things that I also like to track is also my open trades. And how are my open trades doing? So I'll come over to this and let's actually zoom out a little bit so you can see this stuff better. All right, so I'll track my open trades and I want to see how they're doing. So I have 4 on right now. I have RBRK, which is up almost 13.5%. I've got Weave, WEAV, which is up 5.5%. Netflix, which is up about 5.5%. And DOCS, which is up about 1.5%. So I have 4 trades on that are in the green. That's great. Sounds nice. I like it. But it's not where I would be stepping on the gas real hard yet. Here's why. Number one, while I do have stocks that are profitable, I don't necessarily have my stops at break even or better, right? The type of market that we've been in, I've noticed that they need a little bit more wiggle room. For example, let's take a look at Netflix. All right, so here's Netflix. I got in Netflix on this day here. What is that? February the 4th, the last Tuesday. I got in as it broke above the gap up high and pushed into fresh all-time highs. Price started to move. It started to move slowly. If I had raised my stop to break even too quickly, I would have been shaken out on Wednesday because I bought in at $1,001.10. The low of that day was $998.35. I would have been shaken out and not have anything to show for it. I wouldn't have lost very much because I would have been stopped out at break even. But here we are 3 days later, and we're up 5% from that point. So you need to keep the stop a little bit looser, but at a reasonable place. And you need to have mechanisms to figure out, what's a good level? There's a lot of stuff that I cover more deeply in the YouTube channel, in the certainly in the accelerator program where we bring people on. We have conversations on Google Meet, small groups. So again, if you guys are interested in the accelerator program, I highly recommend that you check it out. It's on marwealth.com. You can just scan the QR code and go check that out later. But here's the thing with Netflix and really what with these other trades too. You've got to know where to place your stop. You've got to have a good sense, a good feel of where to place your stop. You also need to be willing to take profits into strength and also be willing to sacrifice some profits as well. How do you know what's worthy to sacrifice? How do you know what you should be doing? Here's the way that I do it. I like to begin selling into strength when I hit twice what I've risked, as a rule of thumb. Sometimes it's a little bit more, sometimes it's a little bit less, but overall, I generally take my first scale out at around twice what I've risked on the trade. So, for example, this one in Weave, I haven't sold anything yet. I started out risking about almost 5.5%. So, my first scale out on this one is, let me see, that looks like it was put in the wrong spot here. Let me go back over to my thing over here. Yeah, 18.4. 18.4. And this is why it's so good to have a journal and write things down in case if your charts get messed up, you have a way to go and fix them. So 18.4. 18.4. And let me just make sure that the stop placement is still correct on that. So I started out with a stop at 1567. That is correct. All right, so we'll come back over to there. So yeah, I'm looking to take off some profit at just above twice what I've risked. The reason why I've set it up this way is because the math works. My batting average, and it's important to know what your stats are. And if you're somebody that that gets a little uneasy about math and stats, but I wasn't really a big math and stats guy either. Those things used to freak me out. I was never an Excel person. That stuff used to freak me out. But as we learn and take baby steps and gain experience, it's what one of the things that I realized was that a lot of it was fear of the unknown. And when I found other people to start to guide me with using some of these tools, and I started to use them more frequently, and I gained a certain level of comfort using them. And stats I see as the same way. So when I dug into my stats, I noticed that most of my trades uh, will go about 10%. Most of my losses will lose about 5%. So I want to maintain that 2-to-1 reward to risk. If I'm doing that, if I start to take off profits at twice what I've risked, the math works out. It works out because I am pretty close to a 50-50 trader. My win rate is about 50%. That doesn't sound like a lot, but if you make $2 when you're right and you lose $1 when you're wrong, it's a coin flip. right? So you would flip that coin all day long, and that's what I'm trying to do with my trading. And so that's that's how I do it. I want to take off some when I start to get to twice what I've risked, and try to ratchet my stop up as quickly as I can, always without choking off the trade too prematurely. And right now, we're in a market environment that's such where you could choke off the trade prematurely if you're not careful. So let's see. Did we touch on everything here? Let me pull up my notes. All right. So we spoke about some key confirmation signals, how to tell if this rally has real strength. The way that you're going to tell if it has real strength or not is your three circles will start to move into the yellow zone and into the green zone. What's the yellow and the green zone? Well, for me, the green zone for the general market right now, we're in the yellow zone. The green zone will be starting to see all the indexes starting to break out and move in the same direction. They're not doing that quite yet. You still have the Russell 2000 that's lagging behind, hitting its head on the 50-day moving average, and it could end up being an anchor to the rest of them. So this part here, still in the yellow zone. Also, the new highs versus new lows, that was a bit wonky. So that's keeping this in the yellow zone too. How about the setups? What we need to see to begin scaling up for the setups would be more high quality trades, more A-level trades, more setups. I'm seeing more setups. A lot of them broke out very strong earnings. I spoke about earnings gaps this morning on IBD Live. A lot of them need a little bit more time. They might be buyable early next week. Then personal performance. I want to see continued traction in the portfolio. I'm getting some traction now. I want to see that continue. And those would be my key confirmation signals to scale up. While I'm talking here, if you have any questions at all, now's the time. Start filling up the comments. Let me know what questions you have on anything that's been said here, or if you have other questions in general. We have maybe about 5 minutes left on this. If we need to go over by a little bit, I'm okay staying if we get a lot of questions coming in. So we spoke about key confirmation signals. We spoke about market internals that matter, time-saving analysis for part-time traders, how you assess market strength quickly. The way that you're going to assess market strength so quickly is exactly what we're talking about here. One of the reasons why I like to look at the major indexes and look at them across time frames and have it all sorted out like this is a lot easier and quicker to look at than going through tons and tons of news articles. What did this person say? What did that person say? What's Powell saying? Let me tune into some earnings call. All that stuff is going to show up on the chart with people with a lot more resources and a lot more capital than I have. So what I want to do is learn how to read this and interpret the signals, learn how to manage risk, and hop along for the ride. And that's something that has saved me so much time through the years. It's been so much more accurate. It's taken off so much stress that it's something where I've been able to be doing this part-time successfully for a long, long time at this point, going back to, like 2011, 2012, when I first found the New York City IBD meetup. That really was such a game changer. And then, of course, finding Minervini and Van Tharp and so many others that we've spoken about on the show before. Let's see. Well, what else was there? Bonus: how to manage risk while positioning for big potential upside. Yeah. So this is key. Yeah. This is a really good one. So we'll have a moment for this. I mentioned this one on IBD Live this morning, but with so many earnings gaps, you'll see a stock like a Palantir had this big earnings gap like this, right? What I like to do is to not buy the day of the gap, because sometimes what will happen is you'll shake out just below the low of the gap. I always like to buy on strength. I always like to wait for the confirmation. So when you get the initial gap up, you wait. You see how it develops. And you don't just look at it on a daily time frame or a weekly time frame. I also like to come down and look at it on a 30-minute chart. And so what it was doing back here, it had pulled back and consolidated and got real nice and tight to the point where it had this little mini resistance level. Here, let me zoom in on this and expand it so you could see it a little bit better. If you just draw a line over here where there's resistance, there was a miniature level of resistance right here from Wednesday. You had the low of Wednesday. That's your range. That's your new range. And if you just wanted to test this level out, getting in at 102, setting a stop down at 98.90, you're able to get into a stock that moves about 6% per day with just 3% risk between your entry and your stop. There's been a lot of stocks that have had huge breakaway gaps on earnings. There's also been a lot of stocks that have completely imploded after reporting earnings. I'm not too fond of sitting through earnings reports when they're like this, where you have huge run-ups, huge implosions. That makes it so much more of a crapshoot. But if we wait and then we come back to it, then so much of the risk is off the table. You're able to get in for a move like this, where you're not dealing with the earnings risk, and price has moved up about 16, 17% from that entry that we just said and gave you 5 times your risk. Those are the kind of trades that I like. I like the high probability, high reward, low risk setups. And I think that will be about it for today. So hopefully you found that helpful. If you did, please drop your comments below. If you didn't, keep it to yourself. No, in all seriousness, if you have critiques, put those into the comments too. I want to make this show as good and as valuable as it could possibly be for you. And the only way that I'm going to know and the only way that I'm going to improve is by your feedback. So please don't be shy. Put your feedback, whatever it is, into the comments, and I'd love to hear it. Until next time, take care, much love, and as always, God bless.
Hey, thanks so much for sticking around to the end. If you're new here, hit the subscribe button down below and become a part of the Mara Wealth community. And make sure that you check out some of the other videos on the channel. They're exactly what you need to see. And leave a comment down below. I read all of them. Leave a comment.